Target date funds, the financial world's version of a slow cooker. Just set it, forget it, and hope your retirement doesn't burn. But what if the thing you've been trusting with your entire future is quietly underperforming while Wall Street quietly profits? Let's talk about why these funds exist in the first place. Because the origin story is actually kind of beautiful in a sad, we don't trust people with money kind of way. After watching Americans blow their 401ks on company stock and gut feelings, Congress basically said, fine, we'll just automate this. And the Pension Protection Act of 2006 made target date funds the default option for millions of workers. The concept is simple enough. You pick the year you plan to retire, the fund does the rest, automatically shifting from stocks to bonds as you age. It's the investment equivalent of cruise control, which is great until the road curves and nobody's watching. Here's the seductive pitch you put money in. Decades pass, you get rich, you retire, the end. But the reality is a little messier, because not all target date funds are built the same, and that gap in quality can mean the difference between a comfortable retirement and eating grocery store sushi at 72. Fidelity, Vanguard, and T. Rowe Price all offer target date funds with the same destination, but wildly different flight paths. It's like 3 airlines flying to Miami. One gives you a window seat and a hot meal, one loses your luggage, and one charges you extra to breathe recirculated air. The fees are where the story gets darker, because some target date funds carry expense ratios of nearly 1% annually, while index fund alternatives sit closer to 0.03%. Over 30 years, that difference doesn't just sting, it compounds into tens of thousands of dollars that never make it to your plate. Then there's the glide path, the way a fund transitions from aggressive to conservative as you approach retirement. And this is where the real philosophical debate lives. Some funds are to retirement, meaning they hit their most conservative point right when you retire, while others are through retirement, staying invested longer, which means more growth potential, but also more exposure if the market decides to have a meltdown, right? When you need the money. The 2008 financial crisis was a stress test nobody asked for. And target date funds with a 2010 retirement date dropped anywhere from 25 to 40% depending on the provider. That's not a typo. People 1 to 2 years from retirement watched nearly half their savings evaporate because their safe fund still had significant equity exposure. Now, to be fair, those same funds recovered for people who stayed the course, and the long-term numbers actually aren't bad. Many target date funds have delivered solid risk-adjusted returns over multi-decade periods. But solid and optimal are two very different words, and this is where the lazy investor label starts to feel a little too accurate. Here's the misconception worth dismantling. Target date funds are not inherently bad, they're just imprecise. They assume your risk tolerance, health, other income sources, and spending needs all align perfectly with your birth year, which, statistically speaking, they almost certainly do not. The real trap isn't the fund itself, it's the set it and forget it mindset that makes people stop paying attention entirely. A target date fund in your 401k doesn't know that you also have a pension, a rental property, and a spouse with their own retirement account, and that changes everything about how much risk you should actually be taking. Historically, investors who combined a target date fund with even minor annual check-ins, just one conversation a year with their allocation, tended to outperform those who genuinely never looked. You don't have to become a day trader to beat the pure autopilot crowd. You just have to show up occasionally. The practical lesson here is this. If you're early in your career with no time, no interest, and no financial background, a low-cost target date fund from Vanguard or Fidelity is genuinely one of the best starting moves you can make. The enemy of good investing isn't laziness, it's paralysis. And target date funds at least get money into the market. But as your financial life gets more complex, as you accumulate assets, accounts, and opinions about things like international exposure or bond duration, the one-size-fits-all wrapper starts to feel a little tight. At that point, you owe it to your future self to at least question whether the cruise control is still aimed at the right destination. The irony is that the people most likely to use target date funds and never look again are the people who would benefit most from basic financial literacy. And the people confident enough to customize their portfolios are often the ones who overthink it and underperform anyway. The The market has a great sense of humor and almost no patience for ego. Discipline, position sizing, and consistency will always matter more than finding the perfect fund or timing the perfect rebalance. Whether you use a target date fund as a foundation or as a placeholder while you build something more tailored, just make sure you understand what's inside it and why. The bottom line is that target date funds are neither a dream nor a disaster. They're a tool. And like any tool, their value depends entirely on whether you're using the right one for the right job. A hammer is great until you need a scalpel. And if you're ready to take your financial future a step further, whether that means real estate investing, home contracting projects, or connecting with the right lenders, check out our links in the description below and let's build something together.